part of the reason why you were so successful was that you were willing to take on more risk with the Sun, or at least you had more confidence that people would write the software and the operating system.
Risk is the wrong word. Let me explain. So when Sun started, I actually had some money left over from my prior company, right? And here was the Series A investors putting in money at the failure valuation. I said, well, I want to invest too. And I did, right? So I was actually one of the Series A investors. And I still remember this day, it was either Bob Sackman from US Venture, or I think it was him, who told me, but Andy, you realize this could be risky. Like you could lose all your money. What I told him is, I don't see any risk. And I didn't. To me, Sun was a zero risk startup because I knew the product would work, right? There was clear demand for lower cost price point. It was just like getting it out the door and selling it, right? So from at least the entrepreneur's perspective, right? I'm risk averse, right? I wouldn't have started a company that had high risk, but being in the field, knowing what the technology does and knowing what the opportunity was, it was zero risk. And quite frankly, most good startups don't have high risk. If you have a high risk, there's lots of things that can go wrong. Yeah. Now, if you have to solve a physics problem in green tech, that's high risk because you don't know how long it could take. It could take 10 years. You may be out of money by the time you solve it, right? But building, taking off-the-shelf components to building a computer that then sells at a different price point than the competition, that was low risk, at least to me. But from the venture perspective, it was risky. I guess they didn't know us yet. So I would say most successful companies took a low-risk approach. They started the timing is really important, of course, right? If in the Sun era, there was, I think in the end, there was about 10 companies that all tried the same thing, right? Mm-hmm. Unix workstation, graphical user interface, and so on. Some started before us. In fact, there was one that went public called Apollo, and it took us a while to pass them. And a whole bunch started after us. But in the end, none of them got the mix right. I mean, they either didn't have the right software or operating system, or they bet on the wrong chip, or whatever it was. They made a mistake, right? And Sun, for better or worse, we sailed right through this. So of course, your technical decisions are ultra important. I mean, you have to build the right product. There's no way around that, right? That is a risk factor. If you get that wrong, you wasted a whole bunch of engineering cycles. But if you build the right product at the right time for the right market and it works, it's pretty predictable. Mm-hmm. And that's true even today. It just has to be a market that's not, that's unencumbered from too much competition.
But somebody has to see the right market.
Yeah, well, this is what the real entrepreneur does, in my mind, is connect the market opportunity with the technology that you need to realize that in an optimal fashion. And if you can do this like in your own head, sort of short circuit, you're much better off than if you need 3 people in the room that all agree, right? Because the more people you need to make a decision, the slower the decision making gets. So a product focus, product marketing focus is actually very important. Then finding the right sales channel, that's actually easier because, you can either sell direct or indirect or, with the internet these days, but, it's basically 3 choices, right? Whereas building the right product, takes a lot of detailed decision making. So Sun actually did go public within, 4 years after we started. And, was a $1 billion revenue company within 5 years. So it was one of the real success stories of the 80s, certainly. And dollars were more valuable than today, right? So it was a very, very nice market opportunity. But the sad thing to me about Sun is that it did not continue on this path, right? And history writers will wonder what happened. Yeah. And quite frankly, the company did not focus sufficiently on the market opportunity. There's no other way to saying this. So a lot of engineering investment was essentially wasted on auxiliary, markets that didn't really materialize. And some of this came down to the people the company hired. The company divisionalized. There were suddenly all these new groups that had to have their own charter, to have meaning of life. But at the end of the day, their charter wasn't that meaningful, and all this opportunity was essentially wasted. So I feel a little sad about this because I think the company could have done a little better. But at the end, there's just a lot of people involved, and
it wasn't. Ideas about why this wound up happening?
Yeah, you're asking the touchy question. So. So I would say, Scott as the CEO was not the product guy, right? So in other words, he was a really good sales guy, surprisingly, right? And he was a good manager. He knew how to organize stuff, but he essentially delegated the product decision to this sort of group of, they were called satellites or planets at one point, right? The little different planet groups. And with this sort of decentralization, it just was disaster. I remember this one meeting where we had lawyers negotiating transfer pricing within the company, And I think even Scott blew up at that moment, but it was just structurally set up incorrectly, right? I mean, you couldn't have one group claiming revenue for, I still remember it's like the graphics group suddenly claimed revenue for the monitors because they didn't sell enough of the graphics card to look good, whereas they didn't actually sell the monitors, they didn't add anything to the monitors, but it came down to this revenue grab and different people, trying to get meaning of life. So in comparison, reading how Apple was organized recently and how they've gotten stuff done, that seems like the right way of doing it. I mean, the intense product focus and just say no to everything else. And clearly, one lesson to learn here is the hardest thing in life is to actually say no, especially if you have a lot of money and a lot of people, right? Because you want to encourage people on one side to think independently and creatively and sort of let many flowers bloom, but it doesn't lead to a better outcome. So the most successful surviving sort of high-tech companies, I think, are the ones that have strong technical management and a very keen sense on where to place their product investments. And the Intels of the world and the Googles of the world these days, and it's it's a big difference between those companies and people that had a lesser product focus. Google, for that matter, was not the first search engine. It was, I think there was 20 search engines before Google, and they were like more or less the last ones. They just had the right idea.
What attracted you to the Google one?
Well, this is a funny story. So David Sheridan, knew of the founders because they were in his class, and he introduced us. And they had a little demo, what they had developed as a student, how it would work. And I was actually very familiar with the concept because I was getting frustrated at finding stuff on the internet. And if you recall, at the time there was Alta Vista, which kind of worked in 94, 95, until people started to gaming the system, because Alta Vista just did sort of a keyword search. And what people realized is if they sort of ended up added dark pages behind the documents, they had the whole dictionary in the dark pages, they would always move to the top, right? Because whatever you're searching for, it would find the document. Of course, you wouldn't find anything useful anymore because it got cluttered with all these people moving up, right? So the idea of Google, which is the PageRank algorithm that is the same principle in scientific or academic publishing, which is it doesn't matter how many papers you read, what matters is how many people cite your paper, right? It's the same basic idea. Was immediately, obvious to me that this is the right way of going. And, I trusted I could build the data structures behind it to build it up for the whole web. And the question, of course, is how do you make money? And the idea was, well, we'll have these sponsored links, and when you click on the link, they collect 5 cents. And I still remember this day, so I made this quick calculation in the back of my head and said, okay, they're going to get 1 million clicks a day at 5 cents. It's $50,000 a day. At least they won't go broke. Okay, it was obvious. I said, okay, I'll write you a check right here. Because at the time, they were talking about licensing technology or joining up with some other companies, and that would have been bad for them, and obviously it would have been a complete missed opportunity. So maybe my contribution to Google was to actually, get them over the hump and getting going, because at the time it wasn't incorporated yet, right? And the lawyers don't pay any attention if you don't have some funding. So I made the check out to Google Inc., which didn't even exist yet. So the check was actually predating the company. And the idea was, they didn't want to attract major venture funding yet because they wanted to prove that it really worked. So they took this early startup capital and built the first, racks and racks of servers to make sure they could actually scale the system. And then when it was time to raise the funding, they went to Kleiner and Sequoia, and they raised, I think, a total of $25 million, and maybe it was 26, but that was the only money they ever went into Google, right? And when they went public, they still had a bunch left. So it was a very profitable and high growth opportunity. But the most surprising thing to Google still for me today was that the real growth started after the .com crash. So most people don't realize this, but if you look back at the S1, the growth really took off in 2001, which is when Yahoo and the rest of the market went down. And the reason, quite frankly, was, as far as I can tell, is that people finally had to figure out where they spent the advertising dollar. I mean, in the late 90s, right, people just wasted these money on these banner ads that nobody ever clicked on. I mean, it was really, I never clicked on the Yahoo banner ad ever. Maybe once, but, it went right by you, right? Whereas in Google, the success rate for the merchant was much, much better. So the return on investment, the only thing that is cheaper basically than Google links is email spam, because it costs nothing, right? But if you actually want to get real customers, the return on investment for these Google sponsored links is terrific. And I think that's still true today because that's where all the eyeballs are. So that has been a very successful, business model. And the weird thing is, in many ways, the advertising has been invented in Silicon Valley, right? This was a thing ruled by Madison Avenue and East Coast and TV networks and all this, but nobody connected, optimized the problem of advertising for the internet, which was, of course, bidirectional, right? The whole notion of banner ads was it's just like a broadcast medium where you buy the millions of prints impressions and you get so many, exhibits essentially or prints on the screen. Whereas the revolutionary idea here was that, it's the customer decides what they want to see.
Yeah.
And it empowers the user. They don't get annoyed by the sponsored links. If they don't want to click on them, they don't click on them. And if they do click on them, they're really interested, right? So it was sort of the optimal form of taking advantage of the full duplex nature of the internet. And nobody else did it at the time. It was just, it was just amazing. It was like, here's the internet, a couple of years old, nobody could find stuff anymore, and with all this stuff going on with Yahoo. And the most obvious thing, which is to really make advertising better, was left to yet another startup company out of Stanford. I'm sure you've seen the recent Facebook social network movie. If Facebook had started at Stanford, they wouldn't have had any of these problems that at Harvard. I'm convinced.
Yeah, sure.
Because basically you need the right mixture of legal advice and people who have done it before and just understanding what it means to do a startup, right? To avoid these kind of traps.
Stanford has learned on this, on the technology transfer, that a good relationship is much more important than a legal document.
We're getting the best terms on this particular deal.
Because the universities that try to squeeze the most out of it often leave a sour taste in the mouth of the inventors.
Right.
Whereas Stanford doesn't try to do that. As a consequence, the people are more generous with us later, and that's turned out.
Yeah, certainly Stanford has benefited from that, but rightfully so.
I'm sorry?
Stanford has rightfully benefited from this generosity.
Yeah.
Absolutely.
Because they've had a more liberal attitude toward that, and because it's kind of been historically in the genes, and so that's good.
And there's so much more to be discovered.
It's not gone yet. You were talking about the concentration here. If you look at the data, in 1995, only about 23% of all venture capitals invested here. Is now 40%.
Yes, that's a new record.
Steadily increasing.
Yeah.
That's a little bit of a mystery.
No, that's actually well understood, I would say. So there are several reasons for that, if we could just talk to this. So one is, people have finally understood that going on planes and traveling around the country is a complete waste of time. I mean, you don't get anything done while you're on the plane, right? So investing locally and avoiding plane rides and going to board meetings in other locations is just a bad idea. But the second and more important issue is that when people looked at the historic success rate with companies in different fields, Northern California just stands out. It's just a higher success rate. And I remember at a client at one point, they had some companies in Colorado, I think it was, and every one of them failed. So they finally said, we'll never invest in another company in Colorado. I don't know what it was, but it's just, it was not worth it, basically. And if you have enough opportunities here, it's not a shortage of opportunities here. Right? Of course, you will miss some things that are happening on the East Coast, but there's plenty of venture firms out there that are competing for those opportunities. So why essentially go into their turf, right? It's sort of a more regionalization effect, I would say. In fact, and the other thing is that there's still venture people setting up new West Coast offices to not miss the boat here. So a friend of mine, works for a British venture fund that's public called, my mind is going blank, Index Ventures? Yeah. And, they sent him back here because that's where the opportunities are. And several other East Coast firms are missing the West Coast, I would say, more than the West Coast firms missing the East Coast.
So that concentration, once you get that concentration going, it enhances itself. You get a
and the risk taking of people here is different because there's so many other opportunities that in the risk is if it doesn't work out, there will be another one, right? But if you do something in, I don't know, New York, well, New York might be a bad example, but it's a more local place, there may not be another opportunity to fall back on. So here people are just ready to jump ship essentially for the next big thing. And there's this historical understanding of the average success rates. So it's easier to attract people than in other places where people don't have that understanding.
That's an interesting point.
I always compare this to people who want to make a movie, right? And if you want to make a movie, you would go to Hollywood. You have all the critical elements, the writers, the people who make sets and the people who manage this down there. You wouldn't do that in Silicon Valley unless it's at Lucasfilm or something. But basically, you need the critical mass of people to do things efficiently. And for startups, it's all here.